The markets have been on a roller coaster ride ever since the S&P 500 peaked on December 6th. But is the fear of inflation warranted? With all this volatility, how can you position your portfolio to weather this and other storms? Here's the problem. During the most recent Fed meeting, Chairman Powell indicated that the number of Fed rate reductions might be 2 instead of 4 in 2025, as everyone was expecting. And then the jobs report came out much hotter than expected several Fridays ago, so the equity and bond markets pulled back even further. Then the producer price index came out soft, followed by a softer than expected consumer price index report. So where's the inflation? The markets seem to be focused on certain data and not all the data. So why all this attention on inflation? Most investors aren't students of economy dynamics and therefore don't understand the relationship between strong job growth, productivity, and inflation.
Well, we got the employment report today, Employment Friday, and something for everyone, but by and large, a strong report. I mean, manufacturing jobs were down, but the headline number was much stronger than expected at around 256,000, with just small downward revisions. Average hourly earnings looked fine. In fact, there was a little bit of a milestone there, 0.3% month to month, but on a year-over-year basis, we finally broke below 4%. Now, we'll get to this in the charts in a minute. If productivity is actually 2% or more, that lower than 4% on the average hourly earnings would suggest that underlying inflation or unit labor costs are below 2%. So the Fed's very focused on labor costs. Productivity is a big part of that.
Look, you can have strong job growth. You can even have wage inflation. But if productivity is going up very quickly, it can easily offset the wage inflation and cause inflation to not be an issue. There's many examples of this having happened in past history. Yes, the PPI appears to be on a recent upward trend. But if we look at the PCE indicator, this orange line, which is the Fed's preferred indicator, you can see that it's been on a recent decline. And in fact, it's in the lower half of its normal range. So right now, it looks improbable that the Fed would ever raise rates, and I stand by my earlier predictions that inflation will continue to come down as productivity gains continue to increase over the coming years. But there's one other unknown we can't ignore that's giving the markets heartburn. The markets don't like uncertainty, and with the November elections behind us, two things are uncertain. One, what policies will the Trump administration put in place that could either help or hurt the economy? Right now, those policies are somewhat of an unknown, and the markets don't like uncertainty. Two, normally investors like it when there's a split in power between the Democrats and Republicans, because then it's harder for the government to get things done and screw things up. With the Republicans firmly in power in all three branches of government, the markets fear things could go too far in one direction and have a negative effect over the coming 4 years. What do you think will happen in the first 6 months of 2025? Will long interest rates stay stubbornly high, or will the Fed continue to lower rates? Please let me know your thoughts in the comments below. With all that, let's go through the current health of the stock, bond, gold, and crypto markets. So if we look back over the past week, you can see we've had a very healthy appetite for risk, with ARK Invest going up the most, small cap second, and then NASDAQ, S&P, and Dow all kind of clustered down here. So this is a pretty good rally showing a healthy appetite for risk. What about over the last month? Well, you can see the zigzag here. Not really any direction, very little direction over the last month. And then if we click to over the last year, you can see that we're still in fairly healthy rally mode, with ARK Invest on the top, NASDAQ second, S&P third, small caps fourth, and the Dow last. And how does this show up in the current bottom dynamics? Well, you can see that the S&P 500 has really been treading water, as I said earlier. It's been really flat to sideways over the last 2 months. And it's really hard to get a read from the bottom forming indicator, this orange line, or the bottom confirmation signal, this blue line, because you can see that the confidence level is all over the map. It's interesting. You can see when the markets are falling, the confidence was falling. When the markets start to rise and turn around, the confidence is going up. That's a good sign. But really no good read here. Really not much to talk about. And then if we look at risk versus opportunity, this I find interesting. So normally I focus on risk acceleration and opportunity acceleration first, but let's look at the backdrop. Let's look at the equity opportunity level. Now, during this time of flat S&P 500 going nowhere, the opportunity level has not only been staying nicely around 60, but it's been increasing and is now above 70. So this looks really good. And if we look at risk, the red line, it's been down below 60, which is where you want it. And it has also been increasing. It's not above 60, it's above 50, and it's certainly below opportunity level. So this tells me there's a net positive bias in the markets. Now, if we look at the risk acceleration, that popped up here a few weeks ago, and then has since pulled back, but then has shot up at the end of last week. And the same with opportunity acceleration, a big pop here, and then it's been falling. And then just like risk acceleration, it's also increasing as of the last few days. So this is really not telling me much of anything except that opportunity is ahead of risk. So that should be a positive for the markets. And what about equity versus safety? Well, let's take a look. It's been a similar picture. So you can see we had a very healthy equity market back here with the NASDAQ right up at the top, especially if you go back to December 13th. But then what happened? Well, small caps fell, fear of inflation, and cash got displaced by all these other things falling and came up here to second place. This is not a healthy look, with small caps falling, S&P falling, and cash rising, even though the NASDAQ 100 was up here in first place. So then go to the 27th. NASDAQ still up here, cash still up here, small caps in dead last, and then you can see what happened. NASDAQ went right to 10th place, and cash went up to first place. And this was a rough couple of weeks. Now, this past week, cash got displaced by gold. Now, why is gold going up? Well, could be fear of inflation, could be geopolitical fears, although I don't see that yet. But you also have a situation where small caps are shooting higher. So this is in conflict with gold shooting higher. So are small caps shooting higher because investors feel that inflation's not going to be an issue and they're buying small caps? Don't know. Now, we've already talked about some of this. You can see that gold started moving higher since back here at the end of December and is now in first place. Cash is in second. And what I don't like is I don't like the fact that the longest duration, highest risk treasuries are all the way down here in ninth, followed by the next longest duration. You want to see this exactly flipped the other way, which would be healthy for treasuries. Now, when we look at the buying and selling pressure, you'll see that treasuries have actually started moving up. So if that continues next week when we look at this, I expect EDV and TLT to be moving up this ladder a bit. So how does the buying and selling pressure look for equities? Well, you can see that the Dow, the S&P, the NASDAQ, and small caps have all been pulling back recently until right here, where they started to pivot and move higher. And you can see that in all four cases. And you can see that there was somewhat of a divergence here. You can see that the selling pressure was falling as the price was falling. That cannot continue. And in fact, it didn't. It turned around here and these started to move higher. So this looks encouraging going into next week. And what about ARK Innovation? Well, ARK Innovation had a very nice rally, but you can see that it's been kind of pulling back here in a very jagged way. So really not a strong look at this point in time. And what about sector rankings? Well, if you look at these tend to not move a lot. They give you kind of a view of more in the rearview mirror, I would say. But if you look at this looks fairly healthy. You've got Bitcoin and ARK Innovation up here at the top, consumer discretionary. You've got the NASDAQ 100, the smaller NASDAQ companies here, technology, S&P 500, small caps. I mean, this is a very healthy looking market a week ago. Well, what about this week? Well, pretty much the same story. It looks very healthy. Cash has not moved up. Gold, surprisingly, is down here given what we've seen. But again, these move very slowly. Now let's take a look at sector rank acceleration, because these tend to change fairly rapidly and kind of give you a sense of where things are headed. But again, you can see that we've got emerging markets right up here at the top. Let's jump right into the overlays and look at what looks good. Well, quite a bit. There's a lot of green on this chart. Now, if you've watched my previous videos, you'll know I make consumer staples and the Dow stocks brown, because when they move up, it's good because they're equities. When they move down, it's good because they're safer equities. So no real tell here. You kind of have to read between the lines, but there is a lot of good going on here with emerging markets up at the top. You've got intermediate treasuries falling back. That's a flight away from safety. You've got cash moving down. That's good. You've got the NASDAQ 100 moving up, clean energy moving up, emerging companies moving up, a lot of things moving up here. Now, so what doesn't look good? Well, not too bad. There's not too much here that doesn't look good. You've got small caps moving lower. You've got gold shooting higher, which we saw in equity versus safety. And then you've got technology, XLK, moving down. But really, relative to all of this other stuff, this is not a bad looking table. And speaking of treasuries, you can see we had a very nice rally over the last week. And it started when the CPI report came out on Wednesday morning. You can see the big jump higher here, and then it continued drifting higher as the week went on. What about over the past month? Not a good picture. You can see there's been a real fear of inflation, and long duration treasuries have not done well until this past week, where you can see they started to move higher. And then if we look back over the past year, these are still way in bargain territory. They're really beaten up. And if inflation, in fact, doesn't become an issue, these are going to be a great place to be. So what about the buying and selling pressure for treasuries? Well, you can see that these have been slightly trending higher, at least at the short end. Now here, when you get up to intermediate treasuries, you can see that when we get to intermediate treasuries, they've been flat over the last 2 months. Then longer duration treasuries, 7 to 10 year, are down over the last 2 months. And long bonds, 20-year bonds, are down even more over the last 2 months. So this feeds into everything that I've been talking about. But what I find interesting about this is if you look at this, the selling pressure really peaked out back here. In fact, it did it in just about all of these. And you can see as the TLT, the 20-year bonds, continued to drop, the selling pressure also dropped. That's a divergence. You can't have that continue forever. And in fact, it didn't. We got down to here and things turned around. Now, hopefully, they will continue higher. And what about that yield curve? Well, if you listen to the financial media, you'll hear them talking about the yield curve steepening. And what they mean by that is these longer duration rates are high, and the lower duration rates, shorter rates down here, are lower, and that's causing the curve to steepen from where it was last month, this red line. And you can see that we're not inverted by 33, almost 34 basis points. So this is starting to become much more healthy as the Fed continues to lower rates. And speaking of that, what do the markets think the Fed's going to do? Well, this is telling me the markets are not at all convinced that the Fed's going to lower rates. There's a 98% chance the Fed will leave rates where they are on January 29th. And if that's what the market thinks, it's highly likely that's what the Fed's going to do. Now, when we get to March, a lot of things can change by the time we get to March, but you can see that the markets are saying, Fed's not going to lower rates even in March, even 3 months from now. What about when we get into May? Same picture. Most investors feel the Fed is not going to lower rates in May. This is why long bonds have been getting beat up so bad and why the stock market has been struggling, because investors, the markets, think the Fed's not going to lower rates until the second half of 2025, as you can see here. And how's gold looking? Well, gold has rallied a bit here, as you can see, especially recently, and you can see that in equity versus safety. And the buying pressure really peaked here. Now, once the buying pressure peaks like this, unless it shoots up again and continues higher, this is likely not going to continue higher. And then Bitcoin, after an amazing 2024 and a huge rally, you can see that it's still somewhat on an upward trend here, but it's very, very ragged and very unsure of itself. Now here again, we have a huge peak in selling pressure, and you can see that it did move higher after that, bounced back down, and is now moving higher again as the buying pressure continues to increase. This looks good going into the next week if this trend continues. As you can see from the price movements and metrics, the equity markets and treasuries have been all over the place and will likely continue to tread water until the new normal can be evaluated. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media. With their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.